thank you for joining me at FutureMoneyTrends.com. I'm here with Nolan Watson, the CEO of Sandstorm Metals and Energy and Sandstorm Gold. Thank you for being with us today, Nolan.
Well, thank you.
Nolan, I'd like to get right into your business model. You were the former CFO of Silver Wheaton. You guys had this royalty business, this stream of income that you guys would get cash flow from other companies. Is this the same business model you're using for these two companies, Sandstorm Gold and Sandstorm Metals and Energy? And is there a difference between the companies as far as their business models at all?
It is a very similar business model to what we did at Silver Wheaton, and I would say when we started up at Silver Wheaton, the second deal we did was better structured than the first one, and the fifth one was better than the second one, and so on and so forth. And Silver Wheaton continues to this day to refine their model. We started up Sandstorm a couple of years ago based on that model, and we have made a number of refinements to it since then as well. So although it's the same business model from a structural perspective, we have made a few improvements on it. One of the key improvements actually is, and you see this mostly on the Sandstorm Metals and Energy side, is we've implemented this concept of minimum cash flow guarantees. So one of the problems inherent in mining is that mining companies, although they eventually usually get up to their full production rates, it usually takes a lot longer and the ramp up's a lot slower. And so what we've built into each of those contracts are guarantees that the companies will ensure we'll get minimum levels of cash flow each year for a certain number of years, so that we can't lose money, and if the projects are behind schedule, then at least we get paid on time. So it's just a tweak to the inherent business model, but it is very similar to the overall streaming model of Silver Wheaton.
Now, Sandstorm Gold went from roughly $4 million market cap to over a $400 million market cap today. When you look at metals and energy, is there a greater opportunity for investors right now in Sandstorm Metals and Energy than there is, when you look at most other junior mining opportunities because of that business model?
There certainly is a larger host of opportunities for us to do deals in the broader metals and energy space. Gold mining and silver mining are very small compared to base metals, bulk commodities, and energy, including oil and gas. So there are more deals to be done there. The company is less than 1 year old, and so it is earlier stage, and definitely the opportunity to get in more on the ground floor than, say, Sandstorm Gold, which is a couple of years old now. But it's the type of thing that I think there's lots of growth potential for many years to come in Sandstorm Metals and Energy. On the Sandstorm Gold, we're actually really just in the ramp-up of cash flow phase. So a couple of years ago when we started that company, we were making investments in mines that hadn't been built yet, and now those mines, some of them have been built and they're starting to cash flow, and we're becoming a slightly more mature business. We're getting about $2.5 million of cash flow per month right now, and that's increasing dramatically quarter over quarter as the mines ramp up. So the business models are at different or the two companies are at different stages. And metals and energy definitely is the more junior of the two in terms of opportunity and stage.
Now, to the average investor, they may look at a chart of Sandstorm Metals and Energy and see a huge drop in the share price. Could you just explain to people what exactly that was?
Yeah, so we were a shell company that had a market cap of just $3 or $4 million and had very little free float. And we put out a press release saying we're buying a number of coal streams, and we raised $100 million off of the back of those acquisitions, and a lot of people got very excited that Sandstorm was branching out its business model into a new area where it had not been done before, that being metals and energy. And a lot of people even went on TV saying how fantastic it was. What most people didn't realize is that the $100 million financing we did, the shares had not free trading yet. So when everyone went out to buy our shares, there's only 5 million shares available to be bought. And the share price had a massive run-up, and then a couple months later when we qualified it with the prospectus, there was a significant precipitous drop, kind of back down to reality. And the share price has definitely been very soft these days, but we're actually now at the point where we have minimum cash flow guarantees and or cash on our balance sheet that is equal to or greater than our entire market cap. So in terms of downside risk, when a lot of people are worried about the fundamentals of the economy and the investments out there and whether or not they should be putting their money into the market or what companies they should put it in, Sandstorm Metals and Energy, I think, offers a very, very unique amount of downside protection, especially given that it still has all of the upside potential of a regular mining company.
Now, why would an energy company, another energy company, go to Sandstorm Metals and Energy to work out an agreement? Why wouldn't they go to a bank?
Yeah, one of our key mottos is that we are safer than a bank. So banks have a particularly bad reputation for when they lend money. They're the first guys that get scared at the first sign of any trouble or any production hiccups or delays or production that's lower than anticipated. And they're also the first ones to call companies in default and to force them either to raise equity, or the bank will go yank their capital and demand repayment as soon as a debt covenant is violated. And one of the benefits of these companies dealing with Sandstorm instead of a bank is that we don't have a whole bunch of debt on our balance sheet. You have to remember that banks are almost entirely financed by debt themselves, and therefore they cannot afford to lose any money, and they act like an entity that can't afford to lose any money. Sandstorm have no intention of losing money, but at the same time, if it takes longer for us to get our money than originally anticipated, it isn't the end of the world for us. So we act more like a partner, someone whose incentives are aligned with the mining company or the energy company, and they're a lot more inclined to deal with us as a result. In fact, a number of the deals we've done have been companies that have significant amounts of debt, and the debt banks are causing them significant problems, and they come to us and say, please just save us from the bank and do a deal with us so we can refinance things, and they effectively give a portion of the economics of their asset to us in the process. So we get attractive assets, we help out the companies, and it's a win-win.
Now, when you guys lock in your cash flow with a company, let's say, for example, the price of copper. What would happen if copper had a significant down move? Would that affect your cash flow?
We get the benefit of the gross margin expanding when the copper price goes up, and we get the flip side of that in terms of the negative of the gross margin decreasing when the copper price goes down. There are two things, though, to remember with respect to that. One is that we are always, when we're making an investment, taking a long-term view of the commodity price. So, for example, a few months ago we did a copper deal, and the copper price was $4.30. Our view at that time was that copper prices were going to drop substantially, and we had a little bit of a bearish view on the overall economy at that time. And so we priced the deal assuming that copper was about $2.30 a pound long term. So even though copper prices have now dropped from $4.30 to about $3.50 a pound today, that we are still, if the mine starts up and running, we're going to be getting significantly more cash flow than we used in the models to make the decision to make that investment. So we're not hurt compared to some of the other companies that were out there. And the other thing is, we actually, when we buy the copper from them under our contracts, in that one contract we buy it at 80 cents. If copper were for some reason, and I don't expect this to happen, but if it were for some reason to drop precipitously below 80 cents per pound, we have a trigger in our contract that says we cannot lose money on any 1 pound. So if copper goes to 60 cents, we would buy it at 60 cents and sell it at 60 cents so that we can't lose any money on that 1 pound. So again, in the spirit of downside risk mitigation, we're trying to create a vehicle that creates lots of cash flow for investors, lots of upside, but it mitigates the downside risk at every turn.
Rarely does a company get me really excited, but hearing you talk about your company and explain exactly the business model really makes me excited about Sandstorm Metals and Energy specifically, because it's still relatively new. When you were discussing like the copper deal, you guys, how many deals do you guys have right now already established for Sandstorm Metals and Energy? And then how many do you have for Sandstorm Gold?
Yeah, so Sandstorm Metals and Energy, we've done deals with 5 different companies. 2 of those are coal companies, and they've got a number of smaller coal mines that we've the stream from each one of those smaller mines. We've done a couple of small oil streams with a company called Terex. We've done a natural gas stream with a company called Thunderbird, and then we've done this copper stream with a company called Donner. So we've got 5 streams in total, covering everything from oil, gas, copper, to metallurgical coking coal to thermal coal. So it's a fairly diversified company already, even though it's only under a year old. And moving over to Sandstorm Gold, that company's about 2.5 years old. We've done 7 streams so far. Those streams are with companies like Luna Gold, with Brigus, with Metanor, with Silvercrest, and all of the assets are in North or South America, and the only one that's in South America is in Brazil. So an incredible amount of political stability, and that's, again, you've heard me say it a couple of times now, but downside risk mitigation is something that we're really focused on. So ensuring that we're doing deals in relatively politically low-risk environments is important to us.
Now, when you look at the general mining industry, the junior mining industry specifically, I guess, what's going on? I mean, some of these companies are producing. You got companies like yourself where, I mean, you just said Sandstorm Metals and Energy has cash and cash equivalent contracts larger than the market cap. When are shareholders going to start to be, everybody who's buying these mining companies is expecting a huge return, and right now, at least in my portfolio, my actual physical metal is beating my mining stocks, and I was kind of hoping it would be the other way around.
Yeah, absolutely. There's a number of things that go wrong when people invest in mining companies, and two of the main things that go wrong are a company will say they think they can produce, say, copper, for example, at $1 a pound, and it's going to cost them $100 million to build their mine. And you fast forward a couple of years later, and you realize they built their mine, it cost them $175 million, and they're producing copper at $1.80 a pound. And so not only did you have to suffer a significant amount of dilution along the way for them to raise the additional capital to build the mine, but when you finally do get there, you're making significantly less money on each pound of copper. And overall, it turned out to be a bad investment, and shares go down when those types of things happen. And we've seen that story play out over and over and over again. We actually did a study on all of the one-asset mining companies that have built mines over the last 7 years, and the average mining company is about 70% late in terms of when their mine starts up versus when they guide it to the market. When their mines finally do start up, they tend to only produce about 30% as much as they said they were going to in the first 12 months, just because commissioning often goes a lot worse than companies expect it to. And eventually the mines do produce as much as they thought they were going to, but usually at quite a bit higher cost. So when you put all of that together, mining companies building mines typically perform significantly worse than people anticipate them to when they make the initial investment. That's one of the main benefits of Sandstorm, is that if a mining company overruns in the cost to build the mine, we don't have to contribute to that. We still have the same stream and same percentage that we thought we did, and we can't get diluted down the way equity holders get diluted down. And then in terms of cost of production, we say we buy copper at 80 cents a pound, then we buy copper at 80 cents a pound. And if it costs them double that to produce it, as long as the mine is economically robust enough to continue to operate, we don't get hurt by that. And so we've got downside risk protection compared to the mining companies, both on the capital side and on the operating cost side.